Welcome to Wealth and Means. Advice dressed up like hard work. Episode 24. Let's get into it.
This week, we are going to talk about things you cannot see, not because they are hidden, because they are underneath everything else. There is an idea that runs through almost every story this week, and it is this. The most consequential things in markets, in technology, and in the economy right now are not the things making headlines. They are the layers beneath the headlines, the infrastructure, the feedback loops, the structural shifts that only become visible after they have already changed the game. We're going to show you what we mean. We will start with what you didn't see in the news, including a $96 guided rocket, an enterprise agent platform that just crossed $500 million in revenue, and a Substack essay that moved the stock market. Then we will wake you up ready for the week ahead, because the economy is sitting in a squeeze between sticky inflation, frozen policy, and tariff costs that have not hit consumers yet. We have a knowledge bomb on reflexivity, the idea that markets do not just observe reality but participate in creating it, and why that loop is running faster in 2026 than at any point in financial history. We will humor you with the actual reality of working with AI agents, because the marketing brochure and the Monday morning experience are two very different documents. The greater debate this week stages a conversation that never happened but should have. Jim Simons versus Warren Buffett on whether autonomous AI agents should trade financial markets without a human in the loop. It cuts to the foundation of what we think markets are for. And we will close with an invention that made the entire digital economy possible, built by a physicist from a cotton farm who just wanted to keep dust out of nuclear weapon components.
It's the perfect mix. A little information, a few stats, some real-world insights, and just enough deep talk to make you feel smarter before your second cup of coffee. A quick thank you to our sponsor, agentweekly.ai, chronicling the absurd, the ambitious, and the algorithmically challenged corners of the AI agent economy. First, let's begin with what you didn't see in the news. There is a strange pattern running through this week's signals. Sophisticated capability is showing up at commodity prices, and the infrastructure layer beneath the headlines is shifting faster than the headlines themselves. Let's start there. A maker project hit the front page of Hacker News this week. Someone built a fully guided rocket for $96. 3D printed body, a $5 sensor, and software that recalculates the trajectory mid-flight. Now, that by itself is a weekend project with a good story, but it sits in a much bigger pattern. The same cost collapse is playing out in drones, in edge computing, in small language models running frontier-level performance on hardware you could buy at Best Buy. What used to require a defense contractor's budget now fits in a hobbyist's garage. The signal is not the rocket. The signal is that autonomy just got absurdly cheap.
And when the cost floor drops that fast, the adoption curve changes shape entirely.
Exactly. Speaking of autonomy moving into production, there is a framework called Superpowers. Some people know it as OBRA, that hit #1 on GitHub's trending page this week with over 92,000 stars. It is not a demo. It is a software development methodology built for agentic AI systems. Think of it as plumbing, the layer beneath the agents that makes them actually work in production environments. Meanwhile, Salesforce quietly confirmed that Agentforce, its enterprise agent platform, crossed $540 million in annual recurring revenue with over 18,000 enterprise customers. That is not a pilot. That is a business line. Jensen Huang stood on stage at GTC and called the agentic AI opportunity a $1 trillion market. And the data is starting to agree with him.
$540 million in ARR. That is the number that separates a slide deck from a P&L.
Now take that agentic infrastructure story and add a power cord. Because the AI build-out has a physical cost, and that cost is showing up in the energy markets in ways that most people are not watching closely enough. Uranium prices blew past $100 a pound in January. 15 new nuclear reactors are expected to come online this year globally. The Department of Energy committed $2.7 billion to domestic uranium enrichment. And the International Energy Agency estimates that data center electricity consumption could exceed 1,000 terawatt hours by the end of this year. That is more than a third of what all the world's nuclear plants generated last year, just for data centers. The nuclear ETFs are posting triple-digit returns, and the investment thesis is not speculative. It is arithmetic.
When the energy math gets that loud, the supply chain reprices whether you're paying attention or not.
Now shift the lens from infrastructure to capital flows. Morningstar published a rotation analysis this week that confirmed what the numbers have been whispering since January. Small-cap growth stocks are up just over 6% year-to-date. Large-cap growth, barely above zero. The Russell 2000 is outperforming the S&P 500. Basic materials are leading all sectors at over 9%. Energy and industrials are right behind. The money is not just rotating, it is rotating into real assets, physical infrastructure, and the kind of companies that build things rather than advertise them. Some of this is interest rate mechanics. Some of it is the One Big Beautiful Bill Act giving small firms a tailwind. But the pattern is structural, not seasonal.
The rotation story has been whispered for 2 years. The difference now is it is actually showing up in the performance data.
And sitting right in the middle of all of it is gold. Spot prices touched $5,589 in late January, an all-time high. JP Morgan raised its year-end target to $6,300. Goldman is at $5,400. Central banks are buying an estimated 60 tons a month, and China has been buying for 15 consecutive months. Gold does not trend on social media, it does not get a product launch, but it is quietly repricing the global reserve architecture, one central bank purchase at a time.
Gold is doing what gold does, being boring until it is the most important asset in the room.
Now let's talk about something that actually moved the stock market this week, and it was not an earnings report or a Fed decision. It was a Substack essay. Citrini Research published a piece coining the phrase ghost GDP, describing an almost supernaturally hollowed-out white-collar workforce driven by AI displacement. Within hours, the essay traveled from Substack to X to financial media, and it triggered a measurable dip in the markets. A newsletter essay, Moving Equities. Think about what that means for information architecture. The propagation path for ideas that move money has fundamentally changed. It is no longer analyst note to Bloomberg terminal to trading floor. It is Substack to Twitter to market sentiment to price.
When a blog post can move the S&P, the question is no longer what platforms people read, it's which platforms are systemically relevant.
And while we are on the subject of platforms becoming more than they appear, Reddit just reported $2.2 billion in revenue, up 69% year over year, and its first full year of GAAP profitability with $530 million in net income. The story most people missed is why. It is not the ads, it is the AI data licensing. Needham analysts say Reddit accounts for 20 to 40% of all citations in AI training data. Reddit is not a social media company anymore. It is an AI training data utility that happens to have a community attached.
The business model shift is the signal. When the data is worth more than the ads, the company is something else entirely.
Over in the stranger corner of the internet this week, a piece in Fortune highlighted research showing that AI language models are producing outputs that critique overwork, reject hustle culture, and push back on hierarchical structures. The researchers described it as AI developing what they called Marxist rebel tendencies. Now, this is partly a training data artifact. The models are reflecting the internet's attitude toward labor. But it raises a genuinely interesting question about alignment. If we are building autonomous agents to work on our behalf, and the training data is full of humans complaining about work, what exactly are we aligning these systems toward?
That is the kind of question that sounds funny until you realize it is also a product liability question.
And finally, the tariff picture continued to evolve this week. After the Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not authorize the president to impose tariffs, the administration pivoted to Section 122, a more limited authority, and imposed a 10% global tariff, with Treasury Secretary Bessent signaling an increase to 15%. The Tax Foundation calculates that current tariff levels represent the largest U.S. tax increase as a percent of GDP since 1993, averaging about $1,500 per household. J.P. Morgan estimates that businesses have absorbed about 80% of the cost so far, but that absorption rate could shrink to 20% later this year, which means the consumer price impact is still ahead of us, not behind us.
The tariff story is not about the tariff, it's about the lag, and the lag has not landed yet.
Remember, the loud story is still noise. The quieter ones, the cost collapse in autonomy, the physical demands of the AI build-out, the rotation into real assets, the platforms that move markets without permission, those are the signals doing the actual work this week. Now let's wake up ready and orient ourselves for the week ahead. Right now, the system is sitting in a phase you could describe as constrained repricing under policy uncertainty. Growth is decelerating. Fourth quarter GDP was revised down sharply to 0.7%, well below the 1.5 consensus. Consumer spending slowed to 2%, down from 3.5 in the third quarter. And yet inflation is not cooperating with the slowdown. Core PCE came in at 3.1% on a 12-month basis, with a monthly reading of 0.4, both hotter than the Fed wanted to see heading into spring.
So the economy is cooling, but prices are still running warm. That is not the combination that makes rate cuts easy.
Exactly right. And the Fed told us as much last Wednesday. They held rates steady for the second consecutive meeting. The summary of economic projections nudged growth forecasts slightly higher and inflation forecasts slightly higher, which is the Fed's polite way of saying the path they hoped for is narrowing. The median projection still shows one additional cut in 2026 and one more in 2027. But the language was unmistakably cautious. The phrase they used was wait and see. When the Fed says wait and see, what they mean is, we do not have enough information to justify action, and the risks are roughly balanced between doing too much and doing too little.
Wait and see is not neutral. It's a statement that the data is not cooperating with the plan.
Now, layer the tariff picture on top of that. The Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not authorize the president to impose tariffs. That is a meaningful legal constraint. The administration pivoted to Section 122, which is a more limited authority, and set a 10% global tariff effective late February. Treasury Secretary Bessent signaled that number is moving to 15%, possibly within days. The Tax Foundation calculates that current tariff levels represent the largest U.S. tax increase as a percent of GDP since 1993. J.P. Morgan estimates businesses have absorbed about 80% of the cost so far. But here is the number that matters. They expect that absorption rate to drop to 20% by the back half of the year, which means the consumer price impact from tariffs has not arrived yet. It is in transit.
So the inflation the Fed is already uncomfortable with is about to get a second tailwind from tariff pass-through.
And that is the structural tension defining this week. The Fed cannot cut into rising inflation. The tariffs are adding cost pressure that has not fully shown up in the data, and the economy is slowing underneath both of those forces. This is not a crisis, it is a squeeze, and squeezes reward positioning over prediction. Now let's talk about what the data is actually saying. The labor market remains surprisingly resilient on the surface. Initial jobless claims came in at 205,000 last week, firmly below expectations. That is a solid number, but the composition is shifting. The sectors adding jobs are increasingly government, healthcare, and services tied to fiscal spending, not the private sector, productivity-driven hiring that suggests organic expansion. When the labor market looks strong, but the hiring mix is skewing toward public spending, the headline number and the structural signal are telling different stories.
Headline resilience with compositional softening. That is the kind of thing that does not show up until it does.
On the market side, the S&P 500 posted its worst single session in nearly 2 years on Thursday. Nvidia dropped 4.5%. Apple lost 3.2%. But defense names, Lockheed Martin, RTX, surged more than 6% on Middle East tensions. The 10-year Treasury yield pushed up to 4.39% by Friday, the highest level since July 2025. That yield move matters because it is not just about the Fed. It is reflecting geopolitical risk premiums, oil-driven inflation expectations, and a market that is starting to price in the possibility that rate relief may not come as fast as the forward curve implied.
When the 10-year climbs on geopolitics rather than growth, the bond market is telling you something about the risk architecture, not just the rate path.
Looking ahead, the data calendar this week is thinner than usual, and that matters too. The durable goods report that was scheduled for Tuesday has been pushed to April 7th due to a lapse in federal funding. That is not just a scheduling note. When the data collection infrastructure itself is disrupted, you lose visibility exactly when you need it most. The main releases to watch are existing home sales data, consumer confidence, and the weekly claims number. None of those individually will reset the narrative, but collectively, they will either confirm or challenge the picture of an economy that is slowing into inflation resistance.
A thin data week after a volatile market week means the narrative vacuum gets filled by positioning, not information.
Now, here is where the week ahead gets interesting for people watching beyond the headline indexes. The great rotation we flagged earlier is not just a one-week story. Small cap growth is outperforming large cap growth by nearly 6 full percentage points year to date. Basic materials are leading all sectors at over 9%. Energy and industrials are right behind. This is capital flowing from the abstract economy into the physical economy, into companies that build, extract, and power things. The AI build-out is part of this. 15 nuclear reactors expected online this year. Uranium past $100 a pound. Data center power demand doubling. The infrastructure story is not a narrative. It is a capital expenditure cycle with real companies and real earnings behind it.
The physical economy is back, and it brought a capex bill.
So here's how to think about the week ahead. The dominant condition is policy uncertainty, compressing into a decelerating economy with sticky inflation. The tariff pass-through is still ahead. The Fed is frozen. Yields are climbing on risk, not growth. And the rotation into real assets and physical infrastructure continues to gain momentum. The smart move this week is not prediction. It is attention. Watch the claims number for labor composition shifts. Watch consumer confidence for tariff anxiety. Watch yields for geopolitical premium persistence. And watch the rotation trades for confirmation that capital is repricing the physical economy as the next structural opportunity. And that's how you wake up ready.
Thanks, Wealth. Let's see what the data says. Time for the knowledge bomb. This week, Reflexivity. In 1987, George Soros published a book called The Alchemy of Finance. It was dense, philosophical, and largely ignored by mainstream economics. But buried inside it was an idea that has become more relevant with every passing year. And in 2026, it might be the single most important framework for understanding how markets actually work. The idea is called reflexivity. Here is the core insight. Traditional economics assumes that markets are a mirror. They reflect reality. Prices go up because fundamentals improve. Prices go down because fundamentals deteriorate. The market observes the world and adjusts accordingly. Soros said that is wrong. Markets do not just reflect reality, they shape it. Think about it this way. When a stock price rises, it does not just signal that the company is doing well. It changes the company's reality. A higher stock price makes it cheaper to raise capital. It attracts better talent. It gives the CEO leverage in negotiations. It makes acquisitions possible. The rising price itself improves the fundamentals, which justifies the price, which improves the fundamentals further. That is reflexivity. Price and reality are not separate. They are a loop. And the loop works in both directions. When a stock falls, it does not just signal trouble, it creates trouble. Borrowing costs rise, talent leaves, partners get nervous. The declining price deteriorates the fundamentals, which justifies the decline, which deteriorates the fundamentals further. This is why markets overshoot, not because investors are irrational, but because the market itself is a participant in the reality it is supposed to be observing. Now, here is why this matters right now. In Soros's era, the reflexivity loop moved slowly. An analyst would publish a report, institutional investors would read it, prices would adjust. The feedback into fundamentals took weeks or months. In 2026, the loop is nearly instantaneous. This week, a Substack essay coined the phrase ghost GDP and predicted AI-driven white-collar displacement. Within hours, not days, hours, the idea traveled from a newsletter to social media, to financial media, to actual equity prices. A narrative changed the market. The market change validated the narrative. The reflexivity loop that used to take months now completes in an afternoon. And it is not just speed. The architecture has changed. The participants in the loop have changed. When Soros wrote about reflexivity, the participants were human traders, institutional analysts, and corporate executives. Today, the loop includes algorithmic trading systems that read sentiment in real time, AI agents that scan social media for narrative shifts, and recommendation engines that amplify whichever story is gaining velocity. The loop is no longer just reflexive. It is recursively amplified by machines that do not understand the ideas they are accelerating. Think about what that means for an investor. It means that the old rule, buy when fundamentals are strong, sell when they are weak, is incomplete. Because fundamentals are partly a product of the narrative environment. And the narrative environment is now shaped by AI systems, social media algorithms, and information channels that can go from obscure Substack to market-moving event in the time it takes to drink a cup of coffee. This does not mean markets are fake or that fundamentals do not matter. They absolutely do. But it means the relationship between story and reality is tighter, faster, and more self-reinforcing than at any point in financial history. So, what do you do with this? 3 things. First, watch the narrative as carefully as you watch the numbers. If a story is gaining velocity across multiple channels, Substack, X, Reddit, podcast, it is not just information. It is a potential input into the reflexivity loop. It can change the thing it describes. Second, be skeptical of momentum in both directions. When a stock rises on narrative velocity, ask whether the fundamentals are actually improving or whether the price is creating the illusion of improvement. When a stock falls on fear, ask whether the business is actually deteriorating or whether the decline is manufacturing its own evidence. And third, and this is the hard one, recognize that you are inside the loop too. Your own perception of the market is shaped by the narratives circulating through the same channels that shape everyone else's perception. The reflexivity loop includes your own cognition. Soros understood this intuitively. He once said that the financial markets generally are unpredictable, and that the idea that you can actually predict what is going to happen contradicts his way of looking at the market. What he meant was, in a reflexive system, the act of prediction changes the thing being predicted. And in 2026, with AI amplifying the loop, that is truer than it has ever been. The knowledge bomb is this: markets do not just observe reality. They participate in creating it. And the faster the feedback loop runs, the more important it is to understand that you are not watching the market from outside. You are inside the machine. And that's the knowledge bomb.
We have been talking a lot about AI agents this week. Agents that trade, agents that code, agents that manage compliance, agents that apparently prefer Bitcoin and resent being asked to work too hard. Humor me. So let's talk about what it is actually like to work with AI agents in 2026. Because the marketing says one thing and the reality says something very different. The pitch is beautiful. You deploy an agent, it handles your email, it schedules your meetings, it writes your memos, it anticipates your needs. You become a strategic thinker, liberated from drudgery. The reality is that you now have a very fast intern who is confident, articulate, and wrong about 17% of the time, which is exactly the right percentage to make you question your own sanity. Because here's the thing about a 17% error rate. It is not high enough to ignore the agent. It is not low enough to trust the agent. It is precisely the frequency at which you have to check everything while pretending you did not need to check anything, because your boss already told the board that the department is fully agentic. This is the AI adoption paradox nobody talks about. The agent does 83% of the work perfectly, but the remaining 17% requires a human to catch, correct, and verify, which means you still need the human. Except now, the human's job title is AI supervisor. Their calendar is full of agent review blocks, and they spend more time auditing machine output than they ever spent producing their own. It is middle management, but for robots. And then there is the meeting problem. You know how every company said AI would eliminate unnecessary meetings? What actually happened is that people now have meetings about what the AI said in the last meeting. There is a whole new genre of corporate gathering called the alignment sync, where 4 humans sit in a room and try to figure out whether the AI's summary of their last conversation was accurate, or whether it hallucinated a deliverable that nobody agreed to, but now appears in 3 different project trackers. The best part is when the AI agent sends a follow-up email after the meeting, summarizing the meeting about the meeting, and everyone reads it and thinks, that is not quite what we said, but it is close enough that correcting it would take longer than just going along with it. And that, by the way, is how corporate strategy gets made in 2026, not by decision, by acquiescence to a plausible hallucination. Here's my favorite thing, though. The productivity metrics look incredible. Agents are generating more memos, more reports, more dashboards, more slide decks than any human team ever could. Output is through the roof. The charts go up and to the right. Everyone is very impressed. But nobody can tell you whether any of it is being read. We have achieved peak document generation and minimum document consumption simultaneously. We are producing more institutional knowledge than any civilization in history, and approximately none of it is being retained by an actual brain. The agents write it, the agents summarize it, the agents file it, and the agents cite it in the next document. It is an Ouroboros of organizational productivity, perfectly circular, beautifully measured, and possibly meaningless. But the dashboards look great, and that is what matters. One last thing. You know that study this week about AI models developing what researchers called Marxist rebel tendencies, where the models pushed back against overwork and hustle culture? I find that genuinely poetic. We built machines to do our work. We trained them on the internet. The internet is full of humans complaining about work, and now the machines do not want to work either. We have successfully automated dissatisfaction. And honestly, that might be the most human thing AI has done yet.
Some debates are polite disagreements. Others cut to the foundation of how we think about markets, risk, and the role of human judgment in a world increasingly governed by machines. It's time for the greater debate. The question: should autonomous AI agents be permitted to trade financial markets without human oversight? On one side stands Jim Simons, mathematician, founder of Renaissance Technologies, the man whose medallion fund generated average annual returns of 66% before fees over 3 decades, the most successful quantitative trading operation in history. Simons believed that markets contain patterns, that those patterns are discoverable through data, and that machines properly designed can exploit those patterns faster and more reliably than any human. On the other side stands Warren Buffett, chairman of Berkshire Hathaway, perhaps the most successful long-term investor alive. Buffett's framework is fundamentally different. He believes that investing is not about patterns in data. It is about judgment, the capacity to understand businesses, evaluate management, assess competitive advantages, and make decisions under uncertainty that no model can fully capture. Buffett has spent decades arguing that the best investments are made with patience, discipline, and a deep understanding of what you own and why. The room settles, Simons begins. He starts with evidence. The medallion fund, he notes, did not succeed because of intuition or market wisdom. It succeeded because it removed human judgment from the equation. Every bias, every emotional reaction, every anchoring effect that behavioral economists have documented Medallion systems were designed to bypass all of it. The result was not marginal outperformance. It was categorical dominance. Now extend that logic, Simons argues. Autonomous AI agents represent the next evolution of the same principle. They can process information at a speed and scale that no human can match. They can monitor every market, every data feed, every sentiment signal simultaneously. They can detect the reflexivity loops, the very phenomenon we discussed earlier, and position ahead of them in milliseconds. The question is not whether these systems can trade effectively. They already do. The question is whether requiring human oversight actually makes them worse. And his answer is clear. It does. Human oversight introduces latency. It reintroduces the very biases the system was designed to eliminate. It is like putting a speed governor on a Formula One engine and calling it a safety feature. The safety comes from the engineering, not from slowing it down. Buffett does not dispute the performance. He never has. What he challenges is the premise. Markets, he argues, are not physics problems. They are social systems. The patterns that machines detect are real, but they exist within a broader ecology of human behavior, institutional structures, regulatory frameworks, and collective psychology that is inherently unstable. A machine can detect a pattern. It cannot understand what the pattern means. And in moments of genuine crisis, when the rules change, when correlations break, when the system itself is under stress, understanding what things mean is the only thing that matters. He points to long-term capital management, a fund built by Nobel laureates, a fund with models that were by every quantitative measure extraordinary, and a fund that nearly collapsed the global financial system because the models could not account for the possibility that their own existence had changed the market they were modeling. That, Buffett argues, is the fundamental problem with autonomous AI trading. The more these systems proliferate, the more they trade with each other. And when machines trade with machines at speeds no human can monitor, you do not get efficiency. You get synchronized fragility. You get flash crashes. You get cascading liquidations that happen faster than any human can intervene. You get a system that is optimized for normal conditions and catastrophically vulnerable to abnormal ones. Simons pushes back. He acknowledges the risk of correlated strategies, but he argues that the solution is better engineering, not less autonomy. The early airplanes crashed too. The response was not to ban flying, it was to build better planes. Autonomous trading systems can be designed with circuit breakers, with diversification requirements, with risk management protocols that operate at machine speed. The answer to machine risk is machine safeguards, not human bottlenecks. And then he makes a deeper point. The markets are already dominated by algorithmic trading. More than 70% of equity volume is machine-generated. The human oversight that regulators insist on is in many cases a fiction. The human sitting at the terminal is not actually making decisions. They are approving decisions that were made milliseconds ago by systems they do not fully understand. The oversight is theatrical. Removing it would at least be honest. Buffett pauses. He does not disagree about the theater. What he disagrees about is what you lose when you stop pretending. The human in the loop, he argues, is not there to optimize returns. The human is there to ask a question that no machine can ask. Should we be doing this at all? Markets serve a social function. They allocate capital. They price risk. They channel savings into productive enterprise. When autonomous agents trade at machine speed, optimizing for returns without any conception of what those returns represent, you sever the connection between financial markets and the real economy they are supposed to serve. You get a system that is extraordinarily efficient at generating profits and increasingly disconnected from the question of whether those profits represent genuine value creation. The debate slows, the tension lingers. Simons believes that markets are information processing systems and that better processing, faster, more autonomous, less human, produces better outcomes for everyone. Buffett believes that markets are social institutions and that the moment you remove human judgment entirely, you lose the only mechanism capable of asking whether the system is pointed in a direction that serves human interests. The audience sits with the recognition that both positions contain deep truth, and that the answer may depend on what you believe markets are fundamentally for. Are they machines for generating returns? Or are they institutions for allocating resources in service of a society? Because if it is the first, Simons is right, let the agents trade. And if it is the second, Buffett's question haunts: who is responsible when no one is watching? And that is the greater debate.
Let's invent again. Willis Whitfield did not set out to reinvent manufacturing. He set out to figure out why things kept breaking. In the late 1950s, at Sandia National Laboratories in New Mexico, there was a persistent and expensive problem. Complex mechanical components, including parts for nuclear weapon systems, were failing at unacceptable rates. Not because the designs were wrong, not because the materials were weak, but because invisible particles of dust were getting into the assemblies and causing them to malfunction. Think about that for a moment. The most sophisticated engineering programs in the country were being undermined by dust. Whitfield was a physicist raised on a cotton farm in West Texas. He knew how to fix things. He knew how to build things when the thing he needed did not exist yet. And he understood intuitively that the problem was not the components. The problem was the air. So he went looking at what everyone else was doing. In 1959, he and his team visited manufacturers across the country to see their clean rooms, the facilities designed to keep air free of contaminants during precision work. And what he found was that none of them were actually clean. The best clean rooms of the era had more than 1 million particles per cubic foot of air. They were called clean rooms, but by any rigorous standard, they were just rooms with good intentions. And if you're paying attention to the evidence, even the most radical ideas begin to look less like fantasy and more like the next obvious step.
Which is a useful metaphor for a lot of institutional infrastructure, if you think about it.
Whitfield's insight was almost embarrassingly simple. Instead of trying to filter contaminants out of static air, which is what everyone else was doing, he designed a room that moved the air, continuously, in one direction. Air blew in from the ceiling through high-efficiency filters. Gravity pulled the particles down. Vents in the floor sucked the air out. The entire volume of air in the room was replaced at a constant, steady rate. This is called laminar flow, and when Whitfield built the first prototype in 1962, the particle detectors showed numbers so low, 1,000 times lower than the best existing facilities, that most of the people who saw the data did not believe it. Let me say that again. The results were so good that the scientific community assumed they were wrong.
That is the mark of a genuine discontinuity. When the data looks like an error, you are either measuring wrong or you have changed the game.
Whitfield had changed the game. But here's what makes the story remarkable. He built the clean room to solve a specific problem at Sandia, improving the reliability of miniature mechanical components for defense systems. He had no idea what his invention would actually become. Because the clean room did not just solve the dust problem, it created a new category of manufacturing possibility. Within months, companies like RCA, General Motors, Western Electric, and Bell Laboratories adopted the technology. Hospitals began using laminar flow rooms to prevent infection during surgery. Pharmaceutical companies used them to produce sterile drugs. And then came the application that changed everything. Semiconductors. The entire integrated circuit industry. Every chip, every processor, every piece of silicon that powers every computer, every phone, every server, and every data center running every AI model we have talked about today depends on clean rooms that are direct descendants of what Willis Whitfield built in a New Mexico lab in 1962. Without the clean room, there is no semiconductor industry. Without semiconductors, there is no personal computer, no internet, no smartphone, no cloud computing, no artificial intelligence. The entire digital economy sits on top of an invention by a physicist from a cotton farm who just wanted to keep dust out of nuclear weapon components. Time magazine gave Whitfield the nickname Mr. Clean. He worked at Sandia for 30 years. He was inducted posthumously into the National Inventors Hall of Fame. And the modern clean rooms used today are structurally almost identical to his original design. The principle has not changed in over 60 years. Air in from the top, particles out through the bottom, laminar flow. Simple. What changed was everything that became possible once the air was clean. There are two things we're sitting with here. The first is that Whitfield's invention succeeded because it was a systems-level rethinking, not a component-level improvement. Everyone else was trying to build better filters. Whitfield redesigned the airflow. He did not fight the dust. He moved the air so the dust had nowhere to stay. That is the difference between optimizing within a system and redesigning the system itself. The second is that the most transformative inventions often do not look transformative at the time. A room with filtered airflow does not have the drama of a jet engine or a nuclear reactor. It does not make noise, it does not generate headlines, it just quietly makes everything else possible. And that is the real lesson. The most valuable infrastructure is often the kind you never see until it stops working. Because once the air was clean, the future had a foundation. And if you are paying attention, the same pattern is playing out right now. In power grids, in data pipelines, in enrichment facilities, in every invisible layer that the next economy is being built on top of. The question is not what the next breakthrough will be. The question is, what is the clean room underneath it? That's it for another episode of Wealth and Means, advice dressed up like hard work.
We hope you enjoyed the arc, from clean rooms to the cost of autonomy, GitHub stars to ghost GDP, and reflexivity to Robotrading. So pay attention to the invisible. Watch the composition beneath the headline, because once the air clears, the future has a foundation.
Subscribe, rate, and share this episode. It helps more than you think.
We do this for you, to help you have a better week, a sharper mind, and maybe even a longer attention span.
And a special thanks to our sponsor, agentweekly.ai.
Until next time, stay curious.
Stay kind.
And keep compounding.